Something happened this week that has massive implications for XRP that almost nobody is connecting. On Wednesday, January 29th, the Federal Reserve held interest rates steady at 4.25 to 4.5%, expected, priced in. Jerome Powell gave his usual non-committal speech about data dependency and patience. Markets shrugged. The dollar index slipped 0.3% that day. Treasury yields dipped, and everybody moved on like nothing happened. But here's what you're missing. That Fed decision just altered the liquidity landscape for cross-border payments in ways that make XRP's value proposition stronger than it was 72 hours ago. And if you understand the mechanics of why a weaker dollar during a rate hold changes the calculation for financial institutions using correspondent banking versus blockchain rails, you're about to see an opportunity that won't last once this gets priced in. Let me break down exactly what happened with the Fed's decision, why the dollar's reaction matters more than people realize, what this means for traditional banking liquidity costs, how XRP solves the exact problem that gets worse when the dollar weakens during rate stability, and why the next 60 days could see RLUSD and RippleNet adoption accelerate faster than any analyst is currently modeling. Because the narrative you're hearing is that the Fed hold changes nothing for crypto. Dead wrong. The Fed hold during dollar weakness changes everything for payment rails that compete with correspondent banking. And XRP is the only crypto asset with live infrastructure positioned to capture that shift. Before we go further, let me be clear about something. If you're trying to understand how Federal Reserve policy impacts cross-border liquidity, how correspondent banking costs scale with currency volatility, how to read institutional adoption signals instead of just watching price, how to position around macro shifts that take months to fully price in, you need frameworks retail doesn't have. That's why I built a comprehensive crypto course breaking down macro policy impacts, institutional payment infrastructure, liquidity mechanics, and portfolio construction for uncertain environments. This isn't theory. This is how you make decisions when traditional finance and blockchain rails are competing for the same trillion-dollar payment flows. Links in the description. Here's the setup most people don't understand. When the Federal Reserve holds rates steady while the dollar weakens, that creates a specific type of strain on international payment systems that banks hate. Traditional cross-border payments use correspondent banking networks, where institutions hold dollars in nostro vostro accounts at intermediary banks to facilitate transfers. Those dollar reserves sit idle most of the time. They're trapped capital. And when you're a bank in Thailand or Mexico or Nigeria, holding millions in dollar reserves to process customer payments, you have to factor in two critical costs: the opportunity cost of capital that could be deployed elsewhere, and the foreign exchange risk from dollar fluctuations. Now think about what happened Wednesday. Fed holds rates at elevated levels, meaning the cost of borrowing dollars stays high for international banks. But the dollar weakens against other currencies, meaning those reserve holdings lose value in local currency terms. That's the worst possible combination for correspondent banking efficiency. You're paying high rates to access dollar liquidity, and the dollars you're holding are depreciating relative to your operating currency. The economics get brutal fast. A bank in Brazil holding 10 million in nostro accounts for payment processing just watched that capital lose purchasing power while simultaneously facing 4.35% borrowing costs if they need additional dollar liquidity. That's a margin crusher. Here's where it gets interesting. Banks have been tolerating these inefficiencies for decades because there was no alternative. SWIFT and correspondent banking were the only game in town for moving money across borders at scale. But that was before blockchain payment rails proved they could handle institutional volume. That was before regulated stablecoins existed. That was before financial institutions had a way to eliminate nostro vostro accounts entirely by using on-demand liquidity through crypto assets. And that's exactly what RippleNet and RLUSD provide. Instead of holding millions in idle dollar reserves, banks can hold $0, execute payments in real time using XRP as a bridge currency, and convert to RLUSD or the destination currency instantly. The capital efficiency improvement is massive, the FX risk disappears, and the cost savings compound every single day the dollar stays volatile. Let me show you the math on why this matters. A mid-size international bank processing $1 billion in cross-border payments annually typically holds 20 to 30 million in correspondent banking reserves. That's capital they can't deploy to loans, investments, or revenue-generating activities. If we conservatively estimate a 10% annual return on deployed capital, that 25 million in trapped reserves costs them 2.5 million per year in opportunity cost alone. Add in FX hedging costs when the dollar fluctuates, which averages another 0.5 to 1% of reserves annually, and you're looking at $3 million in total annual costs just to maintain payment infrastructure. Now compare that to RippleNet with on-demand liquidity. 0 reserves needed. Paper transaction model. Total cost for the same $1 billion in payment volume runs around 0.5 to 1 million, depending on corridors and volumes. That's a 2 to 2.5 million annual savings, and it scales. A bank processing 10 billion annually saves 20 to 25 million by switching rails. Now here's the critical part. Those savings were always available theoretically, but banks move slowly. They need proof of concept. They need regulatory clarity. They need time to build internal infrastructure. They need executive buy-in and board approval. These decisions take quarters, not days. So even though RippleNet has been live for years, adoption has been gradual. But what accelerates institutional decision-making? Pain. When the economics of the status quo get bad enough, committees move faster. Pilots get approved. Timelines compress. And right now, February 1st, 2026, the economics of correspondent banking are getting worse, not better. The Fed isn't cutting rates anytime soon based on Powell's language Wednesday. The dollar is showing weakness despite high rates, which historically signals longer-term structural issues. And payment volumes are growing as global trade rebounds, meaning more capital gets trapped in correspondent accounts just when holding dollars is most expensive. Let's talk about what's actually happening with RLUSD adoption right now, because this is where the abstract macro thesis meets concrete data. RLUSD launched in December with 300 million in backing. By mid-January, it crossed 500 million. As of today, February 1st, RLUSD market cap is approaching 600 million. That's doubling in under 6 weeks. Now compare that to other stablecoins. USDC took years to reach similar adoption velocity in its early phases. Tether grew faster but faced constant regulatory scrutiny that slowed institutional uptake. RLUSD is scaling faster than either because it launched with regulatory compliance baked in, Ripple's existing banking relationships providing distribution, and macro conditions making dollar-based settlement rails more attractive than ever. Here's what nobody's reporting. BlackRock isn't just providing backing for RLUSD reserves. They're positioning RLUSD within their Aladdin platform ecosystem, which manages over 21 trillion in assets and is used by thousands of institutional investors globally. When RLUSD integrates fully with Aladdin's cash management and treasury functions, that's a distribution channel into the largest pools of institutional capital on the planet. Asset managers using Aladdin for portfolio operations could settle trades using RLUSD instead of traditional wire transfers. Pension funds could manage dollar reserves in RLUSD with instant redeemability. Corporate treasuries could use RLUSD for international vendor payments. The use cases multiply fast once integration is live. And the timeline for full integration? Likely Q2 based on how these enterprise rollouts typically work. Now let me connect this back to what happened with the Fed and the dollar. When the dollar weakens while rates stay high, flight to quality usually strengthens the dollar as a safe haven. But we're not seeing that. The dollar index dropped after the Fed hold instead of rallying. That divergence tells you something important about international confidence in dollar stability. Foreign holders of dollar assets are reducing exposure. Central banks are diversifying reserves, and corporations are looking for ways to minimize dollar duration risk. That's where stablecoins become critical. RLUSD offers dollar exposure without dollar duration risk because it's fully redeemable at any moment. You get dollar pricing for transactions without holding dollars in fluctuating reserves for weeks or months. That optionality becomes more valuable precisely when dollar stability is questioned. Here's the part people miss about XRP's role in this system. RLUSD is the settlement layer. It's what financial institutions use for dollar-denominated transactions. But XRP is the liquidity bridge that makes RLUSD efficient across corridors where dollar liquidity is expensive or unavailable. Let's say a bank in South Korea needs to send payment to a bank in Brazil. Traditional route: convert Korean won to dollars using correspondent bank, wire dollars through SWIFT, convert dollars to Brazilian reals at destination. 3 conversion steps, 3 fee layers, 2 to 3 days settlement time, and you need dollar reserves sitting idle at correspondent banks the entire time. RippleNet route: convert won to XRP instantly on Korean exchange, send XRP to Brazilian exchange in 3 seconds, Convert XRP to reals or RLUSD at destination. One conversion step if going through RLUSD. Near instant settlement. 0 idle reserves needed. The cost savings and speed improvement are dramatic. But here's the crucial insight. XRP's role becomes more valuable when dollar liquidity is expensive. If dollars are cheap and stable, correspondent banking costs stay manageable. Banks tolerate the inefficiency. But when the Fed holds rates high and the dollar shows volatility, every day you hold dollar reserves in nostro accounts costs you money. That's when alternatives become urgent instead of experimental. And XRP is the only crypto asset with proven infrastructure for institutional cross-border payments at scale. Stellar has similar technology, but a fraction of the partnerships and volume. Bitcoin and Ethereum are too slow and expensive for payment routing. Stablecoins like USDC solve settlement, but not liquidity bridging across non-dollar corridors. XRP is purpose-built for exactly the use case that becomes critical when the Fed's policy creates dollar liquidity strain. Let me give you the data showing this is already happening. RippleNet processed over $1 trillion in payment volume in 2025. That's up from $700 billion in 2024. Transaction volume on XRPL hit 50 million in January alone, approaching 2 million daily. That's not speculation. That's real adoption scaling in real time. Active addresses on XRPL exceeded 5.2 million last month, up from 4 million a year ago. Those aren't retail wallets hodling for moonshots. Those are payment corridors, liquidity pools, institutional nodes, DeFi applications, and corporate treasury integrations. The network effect is compounding. And here's what's coming that will accelerate this further. Ripple received conditional OCC approval in December for Ripple National Trust Bank. They've applied for a Federal Reserve master account. If approved, Ripple can hold RLUSD reserves directly at the Fed instead of through third-party banks. Think about what that means. Right now, RLUSD is backed by treasuries and cash held at custodian banks. If Ripple gets Fed master account access, they bypass intermediaries entirely. RLUSD becomes backed by direct Fed reserves. That's the same infrastructure backing the dollar itself. No counterparty risk, no custodian failures. Institutional trust goes through the roof. And the approval timeline? Likely Q2 or Q3 based on how OCC and Fed processes typically work. That's 60 to 120 days away, potentially. Now, let's talk about what happened with XRP ETFs this week, because understanding institutional flow patterns matters for reading whether Wall Street is actually positioning around this thesis or just speculating. On January 29th, XRP ETFs saw their largest single-day outflow since launch. 93 million pulled out. Grayscale lost 98 million alone. Headlines screamed crisis. Then, on January 30th, flows reversed. 17 million came back in. 21 shares led with over 8 million. Bitwise added almost 4 million. The panic lasted one day. What does that tell you? Institutions aren't abandoning XRP. They're rotating between funds based on fees and execution. Grayscale charges higher fees than competitors. Capital moved to cheaper products. That's market efficiency, not crisis. But here's the deeper insight. The volatility happened the same week the Fed held rates and the dollar weakened. Coincidence? Maybe. Or maybe institutions are recalibrating XRP exposure based on updated macro assumptions. If you believe the Fed would cut rates in Q1 and strengthen the dollar, XRP's value proposition for liquidity bridging is less urgent. But if the Fed holds rates through mid-year and the dollar stays volatile, XRP becomes more critical, not less. The flows reversed fast because smart money recognized the setup, and the proof is in who's still accumulating. Wallets holding over 1 million XRP added positions through the volatility. Those aren't retail panic sellers. Those are institutions building conviction. Let me give you the contrarian take on why the Fed hold is actually bullish for XRP medium term, even though it felt bearish for crypto broadly. High rates typically hurt risk assets. Crypto sold off Wednesday after the Fed announcement. Bitcoin dipped, Ethereum dipped, XRP dipped. Standard risk-off behavior. But here's what's different about XRP versus other crypto. Bitcoin and Ethereum are primarily store of value or DeFi infrastructure. Their value proposition doesn't change based on Federal Reserve policy or dollar dynamics. XRP is a payment utility. Its value proposition gets stronger when dollar liquidity is expensive and volatile. So while Bitcoin might struggle in a high-rate environment because it competes with treasuries for safe haven capital, XRP benefits because it solves a problem that gets worse in high-rate environments. That's a fundamental divergence most analysts are missing. Here's the math on how this plays out for banks specifically. Traditional correspondent banking requires holding reserves based on expected payment volume. A bank processing 100 million in monthly cross-border payments typically holds 10 to 15 million in nostro accounts. When the Fed funds rate is 4.35%, that's roughly 50,000 per month in opportunity cost just from capital tied up earning zero return. When the dollar weakens by even 1% against the operating currency, that's another 100 to 150,000 in FX losses on those reserves. Total monthly cost, 200,000. Annual cost, 2.4 million. Now run RippleNet for the same volume. On-demand liquidity means zero reserves. Transaction fees run approximately 0.25% of volume. Monthly cost, 250,000. Annual cost, 3 million. Wait, that's more expensive than correspondent banking at small scale. Exactly. That's why only high-volume corridors make sense initially. But scale the volume to 1 billion monthly. Correspondent banking costs explode to 2 million monthly in opportunity cost and FX hedging. RippleNet costs scale to 2.5 million monthly. Now you're saving 6 million annually. And at 10 billion monthly volume, you're saving hundreds of millions. Here's the critical insight. Banks don't switch payment rails for small efficiency gains. They switch when the economics become overwhelming. And the Fed's decision to hold rates high while the dollar weakens just made the economics overwhelming for large volume corridors. The same decision that seemed neutral or bearish for crypto broadly is a massive catalyst for institutional payment infrastructure adoption. And XRP is the only crypto asset with live networks processing these volumes today. This isn't speculative DeFi experimentation. This is Santander, SBI Holdings, Bank of America, and dozens of regional banks already processing real payments on RippleNet. The infrastructure exists, the adoption is scaling. The Fed's policy just accelerated the urgency. Now let's address what analysts are projecting and whether current price action reflects the liquidity thesis at all. Standard Chartered maintains their $8 year-end target for XRP based on ETF inflows and regulatory clarity. But their model doesn't explicitly factor in payment adoption acceleration from macro conditions. If you layer in the correspondent banking displacement thesis I'm outlining, $8 looks conservative. Here's why. Total cross-border payment market is $600 trillion annually according to Swift. If RippleNet captures just 1% of that market, that's $6 trillion in payment volume. At current transaction fees and XRP liquidity requirements, that drives approximately 30 to 50 billion in annual XRP demand for liquidity bridging. XRP's circulating supply is around 55 billion tokens. If 30 billion need to cycle through liquidity pools continuously, that's structural demand supporting multiples of current market cap. You don't need moon math or retail FOMO. You need institutional adoption hitting 1% market share. That's the thesis. More conservative estimates cluster around $3 to $5 base case by year-end. The argument? RLUSD scales to 2 to 3 billion market cap, but doesn't explode past 5 billion. RippleNet grows payment volume to 2 trillion, but doesn't displace correspondent banking at massive scale yet. Regulatory clarity comes through Clarity Act or SEC resolution, but doesn't trigger immediate institutional mandates. Under that scenario, XRP consolidates between $2 and $4 most of the year, then breaks out Q4 when compounding adoption becomes undeniable. That's still 100 to 150% upside from current levels around $2. Not generational wealth overnight, but institutional-grade returns. Here's what to watch over the next 60 days to gauge whether the liquidity thesis is playing out or stalling. First, RLUSD market cap milestones. If it crosses 700 million, then 800 million, then 1 billion, that proves dollar-based settlement demand is scaling regardless of XRP price action. Second, RippleNet quarterly volume disclosures. Ripple reports payment volume periodically. If Q1 shows acceleration past 300 billion quarterly, the adoption curve is steepening. Third, Fed Master Account approval status. Any news from Ripple or OCC about timeline or approval updates changes institutional confidence overnight. Fourth, new bank partnerships announced. Watch for Tier 1 banks in major corridors announcing RippleNet pilots or production launches. Fifth, XRPL transaction volume trends. If daily transactions push past 2.5 million consistently, Network usage is compounding. Sixth, whale wallet accumulation. Those wallets holding over 1 million XRP are at all-time highs in number and total holdings. If that continues through current consolidation, institutions are positioning regardless of short-term volatility. Seventh, exchange balance trends. XRP on exchanges dropped from 4 billion tokens at start of 2025 to under 1.6 billion today. If it drops below 1.4 billion, then 1.2 billion, the supply squeeze intensifies dramatically. Eighth, ETF flow patterns. If weekly inflows stabilize above 50 million after this week's volatility, institutional conviction is intact. If we see consecutive weeks of 50 million plus outflows, mandate-driven buying has paused and we consolidate longer. Ninth, dollar index movements. If the dollar continues weakening despite Fed rate holds, the correspondent banking pain intensifies and urgency for alternatives grows. If the dollar stabilizes and strengthens, the liquidity thesis weakens short-term. Let me address the elephant in the room. What if I'm wrong? What if the Fed cuts rates in Q2, the dollar strengthens, and correspondent banking costs normalize? Here's the reality check. Even in that scenario, XRP doesn't collapse. The infrastructure still exists. RLUSD still scales because dollar-based settlement has value regardless of Fed policy. RippleNet still processes payments because it's faster and cheaper than SWIFT even when dollar liquidity is cheap. The thesis becomes less urgent, sure. Adoption might slow from exponential to linear, but it doesn't reverse. And here's the key. I'm not betting on macro staying perfect for XRP. I'm betting on institutional infrastructure that's already built and scaling. The macro tailwind from Fed policy and dollar weakness just accelerates what was already happening. If the tailwind disappears, you still have the base case of payment infrastructure displacing correspondent banking over years, not months. That's still valuable. Now let's talk about what smart money is doing at current levels around $2, because it's the exact opposite of retail behavior. Retail sees $2 after XRP tested 366 in July and thinks it's going back to $1 or lower. Institutions see $2 and think it's a 45% discount from all-time highs with fundamentals that are stronger than they were at peak. Which perspective makes more sense? In July, when XRP hit 366, RLUSD had 300 million in market cap. RippleNet was processing under 800 billion annually. There were no ETFs. Vanguard hadn't opened access. Ripple didn't have OCC approval. The Fed was still telegraphing rate cuts. The dollar was stable. Today, RLUSD is approaching 600 million. RippleNet processed over 1 trillion. ETFs hold over 800 million XRP. Vanguard opened access to 50 million clients. Ripple has conditional banking charter approval. The Fed is holding rates high while the dollar weakens. Every fundamental metric is better. Yet price is 45% lower. That's called opportunity, and the data shows accumulation is happening. Wallets holding over 1 billion XRP increased holdings through January's volatility. Whale wallets aren't selling, they're adding. Unlike previous cycles where mega holders waited until late Q1 to build positions, they're acting earlier this time. That reduces downside risk even if short-term chop continues. The floor is structurally higher because the infrastructure, ETFs, banking partnerships, stablecoin integration, regulatory progress, didn't exist before. You can't unbuild that infrastructure. It's permanent, and it compounds. Here's the tactical playbook based on your time frame and risk tolerance. If you're long-term bullish on payment infrastructure displacement and believe institutional adoption is inevitable, use current weakness to accumulate. XRP at $2 with the macro and fundamental setup I've outlined represents asymmetric upside. Dollar cost average over weeks. Don't try timing exact bottoms. Build positions as the thesis develops. If you're a swing trader watching technicals, $2 is resistance and 170 is support. Breaking above 220 with volume confirms the next leg up toward 250 and beyond. Breaking below 170 on volume means consolidation extends toward 160 or 150. Set stops accordingly. Don't over-leverage during macro uncertainty. If you're risk-averse or uncertain, wait for confirmation. When RLUSD crosses 1 billion market cap, when Ripple gets Fed approval, when major banks announce production deployments, the thesis becomes consensus and you enter with less uncertainty. Missing a 30% move because you waited is better than losing 50% because you were early. Let me give you the bull case in its strongest form. The Federal Reserve held rates high while the dollar weakened. Correspondent banking economics are getting worse for international banks. RLUSD is scaling faster than any stablecoin launch in history. BlackRock integration positions RLUSD within 21 trillion in institutional assets. RippleNet processed over 1 trillion in payments last year. Ripple has conditional OCC approval and is applying for Fed master account access. XRPL transactions and active wallets are surging. XRP ETFs give Wall Street seamless access through Vanguard, Fidelity, Schwab, every major platform. Exchange balances are at 7-year lows. Over 3 billion XRP structurally removed from liquid supply. The Clarity Act is progressing through Senate committees. If Ripple gets Fed approval this year, XRP targets $5 to $6 as institutional legitimacy gets priced in. If RLUSD scales to 2 billion market cap while RippleNet volume doubles, XRP targets $4 to $5 on pure adoption. If both catalysts hit, plus Clarity Act passage, $8 to $10 becomes realistic by year-end. The infrastructure exists, the macro conditions are favorable, the adoption is scaling. The last week of volatility? That's noise. The signal is that the Federal Reserve's policy is making dollar liquidity more expensive for exactly the institutions that RippleNet serves. And those institutions are already adopting, just methodically, just strategically, just like institutions should. If you want frameworks for understanding how Federal Reserve policy impacts payment infrastructure, how to read institutional adoption signals, how to interpret stablecoin growth versus speculative demand, how to position around macro shifts that take quarters to fully price in, check out the crypto course I've built. We break down real-world scenarios like the Fed's decision this week, teach you how to connect macro policy to crypto fundamentals, and give you decision-making tools for navigating uncertainty. This isn't about predicting rates or timing trades. It's about understanding structural shifts and positioning intelligently, regardless of which scenario plays out. Links in the description. All right, let's wrap this up. Wednesday, the Federal Reserve held rates at 4.25 to 4.5%. The dollar slipped instead of rallying, and nobody's talking about what that means for cross-border payment liquidity. Traditional correspondent banking just got more expensive. Dollar reserves cost more to hold. FX volatility increased hedging costs. The economics that make RippleNet attractive just improved dramatically. RLUSD is scaling toward 1 billion market cap. RippleNet processed over 1 trillion last year and is accelerating. Ripple is applying for Fed master account access. XRP ETFs give institutions seamless entry through every major brokerage. The infrastructure works. The adoption is real. The macro tailwind from Fed policy is strengthening, not weakening. This week's volatility wasn't failure, it was rotation. It was institutions repositioning as the macro thesis developed. And that process is just beginning. The dollar slipped after the Fed hold. The XRP liquidity consequence? Institutional payment rails just became more urgent than they were 72 hours ago. Stay ready, stay liquid.